Welcome back to True Investing for a weekly stock market update for May 6th through May 10th of 2024. Overall, we saw all of the major averages push higher this week, which was led by the Dow Jones rising just over 2%. As you can see from the 30-minute candle chart of the S&P this week, Monday and Thursday were key green days for the S&P's 1.6% gain this week. For our S&P winners of the week, we had Mettler Toledo, Gen Digital, and Vistra Corp. For the S&P laggards, our top three were EPAM Systems, Builders First Source, and Akami Technologies. Although this was a relatively slow week in the market, over 90% of the S&P 500 companies have now reported their Q1 earnings as we approach the end of earnings season. We will also provide a quick preview of some key market moving events for next week towards the end of the video, not to mention our stock of the week. We saw lots of growth-focused companies report earnings this week with a common theme around post-report disappointment regarding the outlook for the remainder of the year. Listing out some notable next-day stock declines from the week, we saw Celsius finishing down a little more than 1% on Tuesday, despite being down over 10% at one point during trading. Datadog was also down 11.5%. On Wednesday, Uber finished down 5.5% and Shopify tumbled 18.5%. And finally, Thursday, we saw Roblox down a whopping 22% and Airbnb declining 6.5%. Now, zeroing in on a couple of those reports, I want to highlight Uber and Shopify, which both reported on Wednesday before the open. Starting with Uber, the ride-hailing giant reported revenue growth of 15% year over year, paired with an 82% increase in adjusted EBITDA compared to last year. So despite that major jump in EBITDA, though, their net profit from last quarter actually flipped back to a net loss this quarter, with a $654 million loss compared to a $157 million loss last year in Q1. This huge discrepancy between the EBITDA jump and the net profit slump was entirely driven by some unrealized losses from the equity investment side of the business. So, despite the continued strong operational performance of the company, investors were not thrilled about the surprise loss in the quarter and sold off the stock. The business has been humming along for a year or two now with very little issue, so this should just be a minor bump in the road for long-term investors. Moving on to Shopify, revenue increased 23% year over year, paired with an increase from a 1 cent earnings per share last year to a 19-cent earnings per share this quarter. Within the last year, they also sold off their logistics arm of the business, so if we exclude that, it was actually a 29% revenue increase year over year. But what sent the stock falling after the report, though, management said they expect to see a, quote, high teens revenue growth rate moving forward compared to analysts' expectations of 19%. They also mentioned that they expect gross margins to fall about 50 basis points. So, although a little slip in margins won't make or break the stock, it's not ideal. Without context on exactly what high teens means, though, Wall Street was not in any mood for conservative outlooks this week, which yielded the stock's worst day in well over a year. Although not a growth stock, Disney reported earnings this week, which was also met with some disappointment from the street, having just recently survived the Nelson Peltz proxy fight and making some headway towards profitability in their streaming division. Disney shareholders were probably feeling pretty positive heading into this week. However, the stock fell just shy of 10% following earnings. The good news was that the streaming division did finally reach profitability, which had been a huge initiative for CEO Bob Iger since he reclaimed the corner office in 2022. The bad news was that they narrowly missed revenue estimates and saw softening in demand in a couple other divisions. They saw year-over-year revenue declines in the linear TV and films division and noted a, quote, moderation of demand in the parks and experiences area. The parks have been a huge boon for Disney since COVID, so that will be worth watching as we move through the next few quarters. We got a snapshot of some new economic data on Thursday with the release of initial jobless claims coming in at 231,000 compared to 213,000 expected. Last reading for initial jobless claims was at 209,000, so this week's number was a considerable jump in claims. After hearing Jerome Powell speak last week about his confidence in the market's ability to cool in the coming quarters, the market is still taking bad news as good news at this point, so this report drove a good chunk of market gains this week after its release on Thursday. Looking forward to next week in the market, both the April CPI and PPI numbers will be released next week, which should definitely provide opportunity to move either higher or lower depending upon the numbers. Some major stocks set to report Q1 earnings next week include Home Depot on Tuesday, Cisco and JD.com on Wednesday, and lastly Walmart, Applied Materials, and Deere on Thursday. I'm particularly excited to see what Home Depot has to say about consumer health and trends after many companies have hinted at a cracking of the lower income consumer so far this earnings season. Will also be interesting to hear what Applied Materials' take on the near term future of the semiconductor market is as well. Last but not least, our stock of the week is the large cap cosmetic giant Ulta Beauty. Ticker symbol is ULTA. Total market cap currently sits around $19 billion. Current PE is 15.4 with a forward PE of 13.7. It was down over 22% in April alone, which helped bring that multiple back down to where it is now. But the stock has performed fabulously for long-term investors over the last decade or so, as you can see by the monthly chart on screen. Recent softness in demand paired with a weak forecast sent investors running for the exit recently, but I think this could be an interesting spot for those long-term investors to add to their position or even start a new position. I do think there's a decent chance we see continually increasing pressure on lower end consumers as we move into the back half of the year, but if they can work through this period of weak demand, this looks like a good multiple to hop on the train. Thanks for tuning in for this week's market update with True Investing. Like and subscribe for more stock market news and update videos.